Good afternoon and welcome to the mid-quarter market commentary review. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Voelker, my business partner and AAMA's Chief Investment Officer. Hey, Phil.
Good afternoon.
How are you doing today?
Good.
Super. Well, as always, the market continues to be in turmoil. And I think let's start out with the economy at large today. You know, the strength of the economy and what the Fed policy may or may not be going forward is probably on the mind of a lot of investors in the marketplace today. Can you take a couple minutes and talk about the most recent data releases and give us some insight into where we are today?
Sure. As everybody's aware, as we've talked about continuously for the last year and a half, the economy continues to defy all of the recession indicators. It's been a year since the first one ticked off with the inverted yield curve, or 6 months after the inverted yield curve. Anyway, the economy continues to tick along, 2 to 4%, actually, in some quarters, real GDP growth. So the guessing game, if you will, continues because, as I said, none of the indicators have been reliable this time around. And the market reactions have been somewhat manic, I would describe it. As an example, with the employment report 2 or 3 weeks ago, there were calls for an emergency rate cut by the Fed. The odds of a 50 basis point cut in September went from 10% up to 85% as far as the market was pricing it. And now here we are 2 weeks later, and we're back down to 40% chance of a 50 basis point cut. So the markets that price these probabilities have been just about as manic as the stock market has been, with very dramatic moves over very short periods of time. So, where are we? The economy appears to be continuing to tick along, ignoring all the indicators. We have, in our last commentary, you'll remember a month ago that we opened the door for the possibility of a slowing of the economy, the earliest possible recession time being early next year. But there's nothing magic that we can point to pinpoint that. It's just that there's several things boiling underneath the surface of the economy that are eventually going to catch up. The housing market has been less than robust, meaning transactions are way down. It's guessed that over a quarter of the market is locked up because of low interest rate mortgages that are in place. Nobody wants to sell those properties. Nobody can force them to sell. And a lot of people have been priced out of the market. And even the new home sales, which have been bolstered by rate buy downs, are starting to flag. And, the home builders can't keep that up forever. They cut quality or size and amenities and buy down mortgage rates, but that's not going to continue forever. So housing is sort of a cornerstone of the economy. That's one area that could easily contribute to a slowing economy sometime over the next 6 to 12 months.
And a Fed rate cut doesn't necessarily mean it's going to be perceived as a good thing. Or if the Fed cuts a lot, won't the marketplace potentially say, wow, maybe they see something worse than the rest of the market is seeing and cause some other gyrations to take place?
Certainly, the markets, meaning in particular the stock market, is cheering for a Fed rate cut. every time the Fed rate cut odds change, um, the equity market reacts pretty dramatically. But let's just say the most likely right now is a 25 basis point cut in September. That's not going to change the mortgage rate. Mortgages are priced off of a longer section of the curve, typically 10 years. That spread's gotten wider as well. So, a 25 basis point cut in the Fed funds rate is not going to cure the housing market, as an example, nor is it going to cure interest on credit cards, nor is it going to cure the basis for a lot of small business lending.
Absolutely. Another theme that we talked about in our last market commentary was concentration. And I think a lot of people are aware that there's a lot of concentration in the market today, in the stock market, and particularly with the Magnificent Seven or even the top 10 stocks in the S&P 500. We did see a pullback a couple weeks ago, which was hit pretty hard. Those Magnificent Seven stocks. Has any of that changed the landscape, in your opinion, today?
Well, not really. I mean, that group that led the increase this year, pretty much single-handedly, did lead the decline in the market, and has led the rebound. So nothing has changed as far as the relative performance of the Magnificent Seven, large cap tech primarily. And so the valuation bifurcation in the market is still there, with the overall market being overvalued. It's just that some of the heavier growth areas, higher growth areas, are more overvalued than other segments of the market.
Any thoughts on AI in general? What we've started to experience or learn about it or perceive about it?
Well, we've written about it a couple times, and AI's been in the works for several decades. Anybody that uses a touchtone phone to access accounts or a chat on a website is chatting with artificial intelligence. It's been around for a long time. It's just that there's development of the sophistication of some of these capabilities that has led to this, not mania, but this gold rush, if you will, to implementing AI. If you look at the mention of AI in corporate earnings reports, it's very heavy. There's been a lot of investment, and time will tell what impact it will have. I'm sure it's going to have a positive impact over time, but I think it may be slower and less dramatic than what some people are expecting. There's been some anecdotal reports. Microsoft Copilot is not being adopted quite as quick as they expected, and there's some higher attrition rate there. There's some anecdotal reports coming out that suggest that the excitement may have been a little bit premature, short term at least.
Okay. Let's kind of wrap things up by talking about our positioning and our tilt towards more defensive sectors, and also what we're doing in the fixed income fund or the income fund within our strategies.
Sure, we've been positioned in a more defensive equity portfolio for several years because of valuations in the broad market and some of the high valuations in the growthier areas. That remains the case today, and every single sector is above median in its PE ratio compared to history. Earnings growth varies across the board, but one of the best projected earnings growth is in the healthcare sector, even though it's still overvalued now at 60, 70th percentile. So in these cases where we do have every single sector overvalued, we look at earnings growth and in particular volatility, historical volatility, realized volatility in some of the defensive sectors is considerably lower than the market. And that's a positive for investors in that if you traverse the same general market over time with lower volatility, it tends to help keep people invested instead of panicking out of the markets. So valuations and volatility continue to support our positioning in the equity side. In the income side, we continue to be fairly defensive with short 1 to 3 year targeted high quality treasury type portfolio, which it's interesting even this year with some of the long rates starting to come down now this quarter. It's outperformed the aggregate bond market by about 60 basis points year to date. So first quarter, the aggregate was down 1.5%, and our portfolios gained. Second quarter, same thing. Aggregate was flat. We're up 1%. Now this third quarter, longer rates have come down a little bit more, so we've lagged a little bit this quarter to date, but year to date still ahead of the benchmark. So there's been some volatility in the bond market, not nearly as dramatically as we had 2 years ago, but it's so far paid to be fairly conservative there.
Absolutely. Well, thanks for your comments today, Phil, and we appreciate everyone listening to our mid-quarter market commentary review. We'll do another one of these at the end of the third quarter in October. And if you have any questions or would like to talk about our portfolios, please contact us. Thank you.